Welcome back, everyone, to the series. It's Major Tom here for International Investing, and this is part 3, how to find option spread setups. And we're going to be talking about iron condors. We're going to be talking about uh, bull put spreads and also bear call spreads. We're also going to be talking about how to find setups. And in this particular part of the series, we're going to be talking about contributing factors to winning spread trades, which are theta decay and vega decay. So tune in if all of that interests you. And without further ado, let's get into it. How to find setups. When do we win a bear call spread? So there's 5 different outcomes that a stock can do. We broke it down for you. So a stock is either going to trade significantly lower from when you enter the trade, it's going to trade slightly lower, it's going to trade sideways, it's going to trade slightly higher, or it's going to trade significantly higher. If we enter a bear call spread, we automatically know that we have a 75% win rate based on part 1 of this series, right? From our option strat tool. If we're playing a bear call spread, we want what's inside of this green box to happen, right? So if the stock trades significantly lower, we get to close our bear call spread early before the expiration date and move on to another play. If the stock trades slightly lower, we're going to move closer and closer to expiration until we get our 50% profit and get out of the trade. We'll talk about our how to manage positions later on. But just know that if the stock trades slightly lower, we are in a win condition or a winning condition, and we can close the trade early. If the stock trades sideways, we may not be able to close the trade early, but as we get closer to that expiration, we are going to be in a winning scenario. And then if the stock trades slightly higher, this is one of those scenarios where you're going to have a little bit of a nail biter, but in the grand scheme of things, you're still going to make money, right? Because if the stock trades slightly higher, but it's still underneath your strike on your short leg of your spread, then you're still going to make money when it expires worthless. Some other contributing factors to you essentially winning this bear put spread setup is some theta decay and vega decay. Remember, theta decay is when time is on your side and every day passes, the stock might not move, but you're still going to gain 1 or 2% from holding that option short. And then vega decay, if you short an option when volatility is high and then the volatility starts to drop, you're going to make passive income every day as that volatility drops and the contract becomes less and less valuable. Now, let's talk about a bull put spread. So notice how stock trade significantly lower is now part of our losing conditions. And part of our winning conditions now are stock trade slightly lower, stock trades sideways, stock trades slightly higher, and then stock trades significantly higher. If the stock trades significantly higher or slightly higher, it allows us to close our bull put spread early, which then allows us to open up another trade before this one even expires, which is awesome. If the stock trades sideways and the stock trades slightly lower, it may force us to hold this contract or this position closer till expiration, but we're still going to make money in the play. Again, contributing factors to a bull put spread, much like the bear call spread, are theta decay and vega decay. Now, the last one we're going to talk about that we use is the iron condor spread. And this one, however, doesn't have as high of a percentage win rate as the other two because it's essentially opening up 2 opposing trades. And if you look at our win conditions here, stock must trade slightly lower, stock must trade sideways, or the stock must trade slightly higher. Now, why would we open a iron condor spread? If the volatility is very, very high and the stock is in between a clear resistance and a clear support, and we don't know which way the price direction is going to go, that's when we open an iron condor. And as a stock starts to push towards the upside, we're going to close our bull put leg at plus profit. And then as it starts to trade slightly higher and then back towards sideways and then slightly lower, we're going to close the upper bound of that trade as well. or just let the upper bound expire and hope that it expires slightly higher so that we still make money on the upside and the downside of the trade. That's how you win an iron condor spread. That is your win condition. Some other contributing factors to even the iron condor spread are also the theta decay and the vega decay. So in all three of these setups, what's the commonality? Stock trades sideways, stock trades slightly higher, stock trades slightly lower, and then theta decay and vega decay are also all of the contributing factors to winning trades. So again, how do we win every spread? Theta decay, vega decay. We cannot always win the direction. That's why we are comfortable being right 75% of the time. Again, we pick high win rate opportunities. However, we can always put time decay into our favor and volatility decay into our favor. This is how we abuse time decay. Like I said when I was describing the variables, we can put time decay into our favor immediately upon opening the trade by not opening spreads past the 30-day curve and capturing the most volatile move downward in price every single trade. Only sell options that expire in less than 30 days in order to abuse time decay. So we over at International Investing never ever open spreads that have an expiration past 30 days. It just doesn't make sense. You don't have time decay on your side that much, and it's just not worth holding a contract that long to make very, very little gains per day. We want to hold contracts that are less than 30 days till expiration that are going to decay quick. Vega decay is the other thing that you can abuse. We can put vega decay into our favor immediately upon opening the trade by only looking for stocks that have recently moved up or down dramatically that have liquid options to trade. Only sell options during the first 1 hour of the trading day when volatility is at its absolute highest. So this is something that I learned from a lot of professional traders, and it's something that you should pay attention to as well. The time of day that you trade matters. I'll say that again. The time of day that you trade matters. All the moves happen overnight. All the moves happen in the pre-market. And when the market opens, that first 30 minutes to 1 hour to an hour and a half are the most volatile time periods in the market. Everyone trades the opening bell. Everyone. So it's just, that's when volatility is at its absolute highest, when stuff really, really moves. So you want to make sure if you are selling options, you want to sell it in the morning when you're going to get the most value out of the volatility being at its absolute highest. Scalp plays the night before or scalp plays in the pre-market so that when market opening bell happens, you're already eyeing a few opportunities and you know where you're going to move your cash. Here's how you find a stock to trade. So up here in TradingView, I have the stock screener open and I'm using the preset top gainers over here. And all I'm doing is I'm adding a minimum $10 in price and a minimum 1 million in volume so they will have liquid options chains to trade. The time of your options that you're getting into is fixed. The price movement is undetermined yet. So all we're doing is narrowing down the volatility by looking for top gainers and top losers. We're going to sort by the 15-minute change percentage, and this is going to give you some good stocks to trade. So I actually did this today on May 9th, and one of the biggest top gainers I saw was Coinbase. Coinbase just recently had earnings on the 5th, and their stock has been running ever since. So we're actually going to look into a example here. So how to know where price will go. So this is Coinbase, right? Coinbase showed up on our scanner. Now here it is. We're breaking down the chart. As you can tell, I'm using engulfing candle and fluid trades as my indicators here. Fluid trades kind of just shows your support and resistance lines, and the engulfing candles just show you nice little buy targets whenever a engulfing candle happens around a support and a resistance line. It is almost a perfect TA buy signal. So I believe in using TA or technical analysis, chart action, and fundamental analysis both in my trades. And I'll show you a little bit of that right here. How do I know where price action will go on Coinbase? Ooh. So for Coinbase, it's currently at $59.86, right? That's right here. What do we have right next to the price? a clear resistance line at $60. What do we also have? If we look over here at the earnings reports, the last earnings was a nice little beat to the upside. However, the forecast for next quarter is lower than what we just reported, right? So this green dot is what we just reported, and this gray dot is what we are anticipating 3 months from now. 3 months from now, we are actually reporting a lower earnings per share, which tells me the company is going to be less profitable in 3 months, which means that all the fundamental traders are playing this stock to the downside, which means I don't want to get into a short-term trade, even with the technical analysis on my side, if the fundamentals aren't also on my side. I want the fundamental traders to be on my side. I want the technical traders to be on my side. I want the big hedge funds to be on my side. I want the market maker to be on my side. I want everyone to be on my side when I enter a trade. I don't want any downside or anyone to come up to my trade and try to tear it down. I want everything supporting my trades. And when that happens, you get a lot more winners, right? So we're taking a quick look at this. We have a clear resistance at the 60 strike and the 62 strike. We have some clear supports over here at the 57 strike, at the 55 strike, at the 53 strike, and at the 47 strike or the 48 strike. That's where all of our key supports and resistances are. This is how we pick a strategy. If price is against a resistance, a support, or is it in the middle? Price is currently up against the resistance, right? So we should open a bear call spread. We're going to call the next highest resistance point our short leg. So we're going to short a call on that resistance line. And that resistance line is going to basically be our break even in the trade. And what it's going to do is it's going to basically we're going to basically put our TA and put our money where our mouth is. So in this example, the resistance that coin is rejecting is the $60 strike. The next highest strike is $62. By opening a bear call spread at $62 on option strat, we can look at our risk profile for this trade. Also, by picking the 62 strike instead of the 60 strike, we are giving ourselves 2 chances to reject off of the 60 and then to reject off of the 62 before we become losers in this trade. So we're giving ourselves plenty of room here. Now, we take a look at this on the option strat. Opening a spread at the 62 strike will expose us to a 57% chance of profit. That's no good. Let's expand our support and resistance lines to find another higher resistance to lower our risk. So even at the 62 strike, we are still at too high of a risk here. If we open up our indicator to show more support and resistance lines, we actually see a very clear resistance here at 66 and then another one at 68. Let's recalculate based on those. So this is what it looks like for a bear call spread that shorts the 66 and goes long on the 68. And this is what it looks like for a bear call spread that shorts the 68 and goes long the 70. So you can see the difference in chance of profit and in net credit. So I break this down for you up here. We now see a resistance at 66 will yield us with a 67% win rate and a 29% return on investment, while a 68 bear call spread strike yields a 71% win rate with a 24.5% return on investment. The name of the game here is preserving wealth, not chasing lofty gains. So we will take the spread on the right-hand side here, the right-hand side of your screen. We're going to short the 68 strike. We're going to go long the 70 strike. That's going to give us a 71% chance of profit in this trade, and it's going to give us a net credit of $49, which is also a 24.5% return on investment. It also leaves us with clear resistance lines at the 60 strike, at the 62 strike, at the 66 strike, and the 68 strike. So we can be wrong up to 4 times. We have 4 separate resistance lines to fall back on before we are wrong and upside down in this trade. That is very, very safe, very, very calculated, and you're also making a 24.5% return on investment in less than 24 days. That is huge. You're making well beyond what an index would return. You're making well beyond what the S&P 500 would return. Here is a bull put spread example. So we're going to show what it looks like to bet the opposite way with a bull put spread. So this stock is actually Wayfair. We found this stock by running the same scanner, but looking at top losers. And essentially what we're going to do is we're going to play the upside, right? Or no, this was actually a top gainer as well. The stock has gapped up since earnings, and it's just currently consolidating before it runs again. So we're looking at, and again, this is another thing that I wanted to bring up. The top gainers and top losers should never determine which way you play the stock. The way that you play the stock is based on the fundamentals in the bottom right of our chart over here, the earnings, and it's also the TA, the technical analysis on the chart. The top gainers and top losers, all it's showing us is the stocks that are volatile. We want to capture that Vega decay in our trades. So that's what we're doing here. We're opening a bull put spread. Why are we opening a bull put spread? Because the current price action of 36.82 is right up against that 36 support line, right? And if we take a look at the earnings down here, we reported around a negative 1.2 and we're forecasting a negative 0.8 it looks like. So that's actually bullish. The stock is going to be more profitable in the next 3 months. Let's take an example here, right? So we have a clear support at the 36 strike and we have a clear support at the 29.50. So we're going to open up our option strategy, and because there is no options on the 29.50, we're going to look at shorting the 30 strike puts, and we're going to go long the 28 strike puts. The stock is condensed against the supply zone or support zone. The fundamental forecast for the company is in the upward direction. We were able to identify 2 key support zones at the 36 and the 29.5 strikes. We're looking at the 29.5 put spread here. That gives us 2 separate support lines to fall back on. We found a 17% return on investment with an 82% win rate here, guys. 82% chance of profit at the 29.5 strike support as our break even. So if we look at our break even over here, if the stock holds above 29.66, that's right at the 29.5 support. That is money. This is a beautiful trade setup. Beautiful. Now we're going to take a look at an iron condor example. So this stock right here is Array Technologies, ARRY. If we take a look at the earnings over here in the bottom right, what do you notice? They just reported, and their forecast is to trade sideways on fundamentals. And if we take a look at the current price action is up here at 18. And the next lowest support is at 1750, 17, and 1625. So it's not quite against the support just yet. Also, if we take a look at our resistance lines, we have resistance lines at 20, 20.5, 21, 22, and it looks like 23. When a stock is in between support zones and resistance zones, and fundamentally projected to remain flat, it's the perfect time to open an iron condor and abuse any price volatility that's recently happened. So if we look back at the chart, they recently had earnings which caused the stock to go from $17.50 all the way up to $20. So now there's a ton of volatility in the stock. Then it proceeded to sell off from $20 all the way down to $18. And it's currently between its support and resistances. So this is the perfect time to open an iron condor on the stock. Iron condors are the best way for capturing volatility without clear price projection to the upside or the downside. Again, it's in between its support and resistance. We're not really that clear whether it's going to go up or down. Even fundamentally, it's supposed to just trade sideways. So what are we going to do? We're going to open a bear call spread, which is this side of the trade, above the current price, which is right here at $19.22. And we're going to open a bull put spread below the current price right here and take a look at the strikes we chose. The short strikes are on the upper and lower supports and resistances. Money, right? We're shorting the 22.5 call, we're shorting the 15 put, and then we're just buying strikes, below the put and above the call. This gives us a 76% chance of profit and a $40 net credit on a $210 max loss, which is really, really good. And our break even here is, we have two break evens. If the stock is between 14.60 and 22.90, we are going to make money upon expiration, because both of our spreads will expire worthless. The Iron Condor spread example. So remember, in this strategy, you are exposed to both extreme upside and extreme downside risk for this trade. It's important to manage the winning and the losing leg of the trade properly in the Iron Condor strategy, which is going to bring me into my last segment, managing positions and also your portfolio with spreads. So last piece of the puzzle here is going to be managing these spreads and managing how much you put into these spreads and managing your portfolio overall. So I've come up with a few rules that I use for myself to keep myself disciplined in managing my portfolio and also managing my trades. And I wanted to share those things with all of you in the next segment of the video. So thanks for tuning in. This one did run a little long, but thanks for sticking through all the examples. All right, see ya.